Good afternoon, everyone. I think it's time to start the webinar. We have quite many people with us now. So thank you, everyone, for joining. And my name is Swati Arora. I'm the partner and co-founder at Hayford Integrated Training Institute. And I welcome you all to our webinar today to know more about transfer pricing in the UAE. Before we start, I would like to introduce our speakers today with me, Mr. Altaf and Mr. Umang. As you can see, welcome Mr. Altaf and Mr. Umang. Mr. Altaf is a partner in AGMS Tax. And he's acting as a leading tax expert in the firm and has been serving himself in the GCC for more than a decade. And Mr. Umang, who's our subject matter expert today, is a transfer pricing professional with an experience spanning over 15 years, built through various senior managerial positions in large consulting and accounting organizations. With this, let me take you through a brief background about transfer pricing. So, Umang, we can go to the content. Yes, so today we will discuss about the basics and background of transfer pricing, the transfer pricing provisions under the corporate tax law, the arm's length principle in the UAE, and the way forward that you should follow. So to give a simple answer to why transfer pricing, we have these examples which we use in our day-to-day life, the Apple phone, the Starbucks, Googles, so it's easier to relate. So these are some of the companies who were charged with an allegation during the period of 2010 and 2013 that they have abused the transfer pricing rules. As you can see in the description, we have mentioned the extent that they had tried to evade with abusing the transfer pricing rules. So these companies, they use the transfer pricing mechanism to recharge profits from one center to another so that they can park their profits in the low tax regime and hence avoid the taxes. So they structured their transactions that help them to derive the profit in the jurisdiction, which is low tax, and hence the high tax countries are left with no or low profits, resulting into avoid of tax. So government wanted to avoid this abuse, and then the OECD came up with the BEPS. I mean, we can go to the next slide. Yeah, came up with the BEPS action plan, which is the base erosion and profit shifting avoidance, basically, to avoid such misuse of the rules. As you can see here, the OECD introduced right from 2013 the abusive tax practices, the rules to avoid such abuse, and in 2015 they released a 15-pointer action plan, which is called the BEPS action plan, which aims to achieve coherence and in the jurisdiction, to have more control and such avoidance of such malpractices in the region. As you know, UAE was in the red alert, and we need to follow these principles to be out of any malpractices. So some of these action plans were aimed to achieve the objectives where result of transfer pricing were in line with the substance. Now, as you can see, action plan 8 to 10 and action plan 13, they were also introduced whereby the companies have started to do their country by country reporting, and they have aligned the transfer pricing outcome with value creation, intangible risk, and capital high risk transactions. Next slide, Umang. So these are some more examples, which is referred to as the inclusive frameworks. So these are included in the BEPS action plan, and of course, the companies are bound to follow these action plans as well, just for a quick reference. Now, UAE as such, there was no literature in the UAE. It was very limited. So the OECD has recommended the material which we have highlighted here. It's called the OECD Transfer Pricing Guidelines, which is issued in the January 2022. And it's a book of around 700 pages. So you're free to study it on your weekends, on your free time, or else maybe use the services from Umang. He will take you through that. Over to you, Altaf. I think it's time that you give your insight on the topic and let our attendees have a lovely time listening to you today. Thank you.
Thank you very much, Swati. Naturally, the corporate tax law has been issued in UAE, and that is why we have come across the matter of transfer pricing itself as well. Umang, if you would go to the next slide. Thank you. So the journey, the way transfer pricing issue has been addressed in UAE in the year 2018, there is an organization which is called the Inclusive Framework. So G20 countries and OECD, basically, they are the ones who are leading international taxation related matters around the world. Around 137 on 139 countries actually signed their model tax convention, and this organization was formed called Inclusive Framework. So in 2019, country by country reporting related guidelines came into play. And now, so those organizations which have multi-jurisdictional presence, so usually there's a framework which requires that a country by country reporting should be made, so that it can become visible as to what kind of cross-border transactions are there. Then again, another report, another framework, which is the concept of economic substance, that came into play in the year 2019, as the name suggests, and it is, as a matter of fact, nowadays a big point of discussion when it comes to, for example, a favorite topic of tax practitioners as well as those organizations who have their presence in free zones in UAE. Economic substance, what exactly is it? Like, there are so many companies which are kind of paper companies, where we have simply opened up an organization or trade licenses there, and that's it. And people might claim that we have presence in free zones. So to challenge that, to address that, the whole framework of what is economic substance came into play, and it identified and it explained that no, just having a paper company or a conduit company is not enough. So you should have enough presence, assets, etc. This is the concept of economic substance. Then naturally, in 2022, finally, in the month of December, the corporate tax law was introduced. There were some other few dates as well before, in July 2022, for example, when UAE started consultation process, etc. Frequently asked questions were issued, and after a lot of aggressive discussion, finally we got corporate tax law in place. And later on, in the month of May, actually it is not presented on the slide, but I'm just telling you, in the month of May 2023, that corporate tax decree law that was issued in December 2022, we obtained a flurry of decisions, both cabinet decisions and ministerial decisions, which amplified, which explained too many things that were addressed in the provisions. And now we have a very well visible corporate tax law related guidance available with us. Can you please go to the next slide, sir? Right. So frequently asked questions is a way of basically simplifying those complex provisions that are written inside the decree law. So if you go to the Federal Tax Authority's website, you will find that they have identified there. One of the frequently asked questions is on transfer pricing rules. So the question was, what are transfer pricing rules? And the answer was that the whole idea is basically it revolves around related parties. So the concept of related parties is very important to understand transfer pricing. Any transactions between those parties, those two parties, in which one party kind of influences or controls, to be quite honest, the right word is control rather than influence. If one party can control the economic activities of the other parties or decisions of the other parties, then those two are usually known as related parties. So those parties can sometimes do an abnormal pricing of transactions, and in this way one party's profit is transferred to another party. That is profit shifting, which Swati was earlier on mentioning. So in order to curb that, the law says that any transaction between such parties must be at arm's length. So in order to prevent manipulation. Actually, the word used is market value. So in any two related parties, whenever they transact, the pricing must be done on market value. We're going to learn more about what is market value in the coming slides. Now, if we look at the corporate tax decree of the UAE, there are certain sections such as Article 34. Now, that article is purely, as the name suggests, it explains that arm's length principle must be complied whenever there is a transaction between related parties. When one company interacts with another company that is a related party, or when one company deals or interacts with connected persons, you're going to see that these two matters have been discussed in Article 35 and 36. So Article 35 identifies what exactly do we mean by related parties and what is the meaning of the word control, expression control. And Article 36, it addresses any payments to connected persons. Now, interesting point to note here is they didn't write salary or bonus or any other thing. They have used a universal word, which is payments. So that, you know, any person, any manager who wants to, you know, play around the law should not find that escape route available. So they use the word payment, which is a universal word. It can be salaries, it can be compensation, it can be bonus, anything at all, if a payment is made to connected persons. And we are going to learn about connected persons like the owners, directors, etc. in the coming slide. That payment must be at arm's length. Then there is another Article 55, which addresses essentially as to what are the transfer pricing related documentation, what kind of compliances would be there. Please, can you move to the next slide? And any question you guys ever have? You have the Q&A menu available. You should be able to see it in the screen. You can write it there or even in the chat menu, and Swati will pick it up, inshallah. So coming to certain specific provisions like Article 34, if you remember, that was on arm's length principle. So the specific wordings that you see in determining taxable income transactions and arrangements between the related parties must meet arm's length standard. So it can be transactions, it can be arrangements, but whatever the case, whatever activity business is being performed between the related parties, it must be at fair market value. And what is that standard? If results of the transactions or arrangements are consistent with the results that would have been realized if persons were not related parties. So a very interesting reverse engineered way of telling or explaining. Say this transaction that we did with a related party, if we had done the same transaction with a third party whom we cannot affect or influence or control, then what would have been the pricing levels? That gives us guidance on what is arm's length. And circumstances should be similar, because exceptional circumstances are possible. Sometimes there can be forced sale scenarios, etc. Those are exceptional circumstances in normal course of business in similar circumstances. Now, another frequently asked question on related parties as to who exactly are related parties. We've addressed this already, but now you are going to get a specific reference point here with respect to related parties. So this question was, who are related parties? And the answer in the related article, I think Article 35, they have identified basically two criteria. One, I call it the 50% rule. Now, what is that 50% rule? It can be 50% of the shareholding. It can be 50% of the voting rights in the other company. It can be the right to receive 50% profits or even liquidation proceeds. So all of those 50% rights or ownerships, that will make one party as the related party of the other. But then again, that article says another very interesting thing. There may not be a 50% rule applicable there, but one party would be able to exert control on the other party by virtue of a covenant or memorandum of association or any other legal instrument. And if that is established, even without the 50% rule, that these two parties will be seen as related parties. So I hope this clarifies. clarifies. Yeah, we can go to the next slide, please. There can be a pre-existing relationship between related parties, or in the course of events, it can turn out to become a situation where one party has now become a related party of the other. Now, this is a little bit further discussion on the Article 35, which addresses related parties and control. So, natural or juridical person who has directly or indirectly. Why did they use the word indirectly? The answer, I hope quite a few of the participants who are there would be professional accountants or related to law in one way or another, or at least they understand that what is a group structure. So usually in a group, there is a parent company and then there is a subsidiary. But in certain larger groups, there can be a parent company, then a subsidiary, and then another sub-subsidiary, a second-tier subsidiary. That's why they've used the word indirectly. So if natural or juridical person who has directly or indirectly a relationship through ownership, fine, a direct ownership, direct shareholdership, or control 50% of ownership, or that ability to control. And the third thing is it is specific to natural persons kinship, which is up to 4th degree of kinship, like great grandfather. They have a common great grandfather or mother. That if this kind of a relationship exists, now you would ask this question: how are we even going to identify? So an interesting area specific to the Middle East where we are sitting is the tribal system. So in a tribe, usually see many people or even family system in India. So in a family or in a tribe, there's a good chance, likelihood that when we go to the 4th level, father, grandfather, great grandfather, and great great grandfather. So if there is a high chance that your far-fetched cousins would still become a related party to you. That's for natural persons. Now, there's another concept that has been addressed in corporate tax law, which is called permanent establishment. So what is a permanent establishment? Basically, a resident person can have its existence or presence in a foreign jurisdiction. That can happen through a branch. It can happen through an agent, which is kind of a dependent agent who's working only for you, or it can be an organization. It can be a human being, your director you sent to another country who's there for more than 6 months, etc. So all of these ways are the things that make a permanent establishment. So permanent establishment will also be considered as a related party of the original entity. Then again, in case of trust or foundation, there can be trustees or founders or settlers if something is being settled in case of liquidation, etc., or a beneficiary. Trusts are formed sometimes for a beneficiary, the beneficial recipient of economic benefits. So all of these will be related parties of that organized entity, the trust or foundation. So yeah, we can go to the next slide. So the same Article 35 talks a little bit about control. We've already discussed, I mentioned the same thing. I'm going to repeat that the 50% rule you can see on here in the first 3 boxes. To easily understand, a simple majority is typically sufficient to exert influence. So what is a simple majority? Usually it is seen as 51%. But please remember, in UAE, in those organizations where even 2 shareholders exist, each of them has 50%, then we will still say that both of them are in control of that entity. That is why UAE corporate tax has considered not 51% but 50%. So control would exist even in 50% case as well. So the first 3 exercise 50% of more voting rights, or 50% or more profits, 50% or more board of directors. One party can appoint for another party, one company can appoint for another company, or determine significant influence on the conduct of business. So some of the interesting examples can be, for example, a management company. And these are practical case scenarios that we've come across during the course of our practice. If some management company has been appointed for a particular type of business, and through a covenant, it has been very strictly written that this entity is going to exercise absolute control on the other entity. That is a very strong evidence or basis to say that this management company even though it does not hold that 50% shares or 50% voting rights or appointment right, it still has that capacity to exercise control over this other entity. So that is how these are the various types of control. We can go to the next slide. Yeah, this is a very interesting, pictorial graphical representation of how this kinship rule would work. You can see on the extreme left, you can see great grandparents are identified. Now, naturally, then the second level would comes in. Actually, I would call it the third level. The great grandparents would be the fourth level, fourth degree of kinship. Then the third degree is the great grandparents. Then naturally the grandparents, that is the second degree. Then parents, which is the first degree of kinship, and then it goes on. Actually, it will go on to the next generation as well. Very comprehensively prepared pictorial presentation. So we can go to the next. We have another slide 245. Sorry, we have another frequently asked question in the frequently asked questions document. You can actually download this document from FT website as well, just to let you know. So question number 245 says, who are connected persons? Now, those people who do not know that much of corporate tax law, or for that matter, corporate law, in our experience over the last 1.5 years that clients have been interacting, majority of times people have asked this question, that what is the difference between the related parties and connected persons? So it's a very common question. So the answer is pretty simple. First, first obvious answer is that usually most of the time connected persons are individual human beings, whereas related parties can be natural persons as well as legal persons. That's the first something that for you to remember. And when we read the definition of connected person, it becomes very clear to us as to what is the intent of the law. So the three things that you see here, these are precisely the words that have been used by the by the relevant article that has defined the connected persons. I think Article 36. So the first category is owner of the business. Now, again, owner is a very universal word. The interpretation of it can be, it can be a shareholder, it can be a partner, or any other way of ownership. In case of trust, it can be a trustee, etc. Second is director. Now, why director? Directors have, by virtue of law, corporate law, gives the directors that capacity that they are the last line of running the business, to be quite honest. Now, another interesting angle I want to share with you, that usually in the commoner, the layman, tax layman, interchangeably use the terminology shareholder and direct in place of director. So whenever they're referring to shareholder, they would say, well, directors of the company are such and such and such. Please note that in the world of corporate law, and for that matter, in the world of corporate tax law as well, director is a different person than shareholders, meaning that the meaning of the word director is different from the meaning of the word shareholder. You cannot use these interchangeably. Yes, same shareholders can be appointed as directors, but that does not change the fact that the meaning of the word directors is different from the meaning of the word shareholders. That's two categories. Third category that has been written is a very interesting angle: related party of either of the above. So it can be owner, it can be director, it can be a related party. I missed one point. I'm going to emphasize on this point, and you're going to see that point in another slide. We have a full-fledged slide. It can be an officer of the company as well. I will keep that once the officer comes in. I will discuss that. Now, again, a little bit more discussion on connected person. A person shall be considered as connected if that person can be an owner, a director, an officer. We'll see about officer. Or it can be a related party of the owner or a director. Like, I can give you an example. For example, let's say there is a shareholder in a company, and that shareholder's brother is appointed as a finance manager in the same company. So whatever salary you pay to that finance manager will be seen as a payment to a connected person. Why? Because that finance manager is a related party of the shareholder. So that's an example just for your consideration. Payment to connected persons, again, just like payment to related parties, must be at an arm's length value. It should reflect the market value, as explained earlier. Provision as to limitation of deductibility will not apply to listed entities, taxable persons subject to regulatory oversight, or any other persons determined by the cabinet decision. Why listed companies have been kept out of it, or for that matter, those entities which are subject to regulatory oversight? Listed, everybody knows. Okay, listed entities are those which are listed on Abu Dhabi Stock Exchange or Dubai Financial Market or Nasdaq, right? That is listed company. What about those entities which are subject to regulatory oversight? That those taxable persons. So the answer to that is sometimes banks, insurance companies, even certain other types of companies may not be listed, but central bank or another regulatory body is very closely doing the regulatory oversight for those. As a matter of fact, if you remember, like recently some laws on DNFBP were issued, designated non-financial businesses and professions. Those entities may also be subject to regulatory oversight. So it has to be seen, although there's nothing written as such whether DNFBPs will be there or not. But we need to remember that particularly for banks or insurance companies which are not listed, they are still seen as subject to regulatory oversight and any other person that the cabinet decision may specify. So this deductibility will not, issue on deductibility will not apply on that. Now, coming to Article 36 on the connected person, office discussion on the word that was used there as officer. Very rightly written here that this terminology, officer, has actually not been defined in the corporate tax law. However, and as a matter of fact, it is rightly written that it has not even been defined in VAT law or tax procedures law as well, and even in commercial companies law as well. But an interesting angle is that in all the mature jurisdictions of the world, if you look at the corporate law, that law uses this word officer in many places. The Cambridge Dictionary has been mentioned as officer as someone who has a legal responsibility, legally responsible for a company. Another dictionary meaning is someone with legal responsibility for a company, some person such as director, company secretary, etc. There are many officers that will have a regulatory approval. In case of banks, even at the time of appointment of CFO, central bank will have to approve that. Chief internal auditor, it will have to be approved by the central bank. If you go to the next slide, I think it is the word CXO has been meant. Yeah. So if you read that blue box at the end, it's a very rightly put thing, that this word officer could mean head of departments, even CXOs, all the C-suite officers, any manager, and yes, you might be feeling surprised at why the word manager is coming here. Why would manager be seen as an officer? Answer to that is, sometimes, for example, in case of certain insurance companies, quite a lot of insurance companies which are actually like branches of foreign entities. So if you look at on their trade license, you will find that the branch manager's name is reflected on that trade license, written as general manager. So that becomes like that shows that this general manager is so important to this branch of that foreign entity that his name is being reflected on the trade license. So that is why it is rightly written on this slide that even a manager sometimes can be deemed as an officer and can be seen as a connected person of an entity. So yeah, we can go to the next. So now coming to the Article 55, I think I've overtaken my time, but anyways, I'll be a bit quicker. So this transfer pricing document, essentially, what are the things that are needed to be done under the UAE corporate tax law? It says entities may be required to file a disclosure of a transfer pricing disclosure form may need to be submitted. That's one thing, and it will be done together with the return. In addition to that, there may be a master file and a local file that would require that are required to be maintained. There's a decision that amplifies that. Any document and documentation that FTA requires has to be submitted within 30 days of the request. Yes, we can go to the next, please. Now, coming to the ministerial decision number 97 of 2023, that gives conditions for maintaining local and master file. Now, some entities are effectively part of a much larger entity. We call them multinational enterprise under the transfer pricing frameworks or transfer pricing concepts. So what are those multinational enterprises? Actually, those organizations whose global consolidated turnover is more than 750 million euros. If you translate 750 million euros, it becomes 3.15 billion AED. So if that organization, if a subsidiary of that organization is in UAE, so we will not look at what is the turnover of that entity. We will simply consider it as subject to transfer pricing regulations. That's one thing. Or it can have, or another entity which is not really part of an M&E multinational enterprise with all that big revenue, global consolidated revenue of 3.15 billion. If an organization is only a UAE organization, but it still has a revenue of 200 million or more, then this transfer pricing documentation, the master file and local file applies. Yes, you can go to the next, please. Now, transaction arrangement with the following related parties or connected persons to be included in the file. Which ones are those? Non-resident person and an exempt person that also will become a resident person that has elected to avail small business relief. So, you know, although SBR is a kind of a relief that is given, but any transaction with those persons will need to be included in the local file. A resident person whose income is subject to a different tax rate. The standard tax rate in UAE is 9%, but there could be a situation where a 0% tax rate is applied to the income, and I'm referring to qualifying income, qualifying free zone person, or there can be that 15% rate, so differential tax rate. So if that is the case, these will be included in the local file. You can go to the next, please. Now we are coming to the exclusions. What those transaction arrangement which are not required to be included in the local file. Those transactions which are with resident person other than the exempt SBR or differential tax rates, as we discussed in the previous slide. Though if those transactions with resident, no need to include them in the local file. Transactions with natural persons, we don't need to include them, or a juridical person solely by virtue of being a partner in an incorporated partnership. Subject to, there are certain conditions that have been mentioned. If a legal entity is acting as a partner in an unincorporated partnership, then the transactions with that legal entity need not be included in a local file. Now those conditions have been elaborated. Conditions for excluding natural and specific jurisdiction juridical persons. So if they're acting independently, whereby the transaction arrangement are undertaken in an ordinary course of business, then there is no need to include those transactions in the local file. And not exclusively or almost not exclusively. If that is the situation, if there are multiple entities and parties involved, so it's not an exclusive situation, then there is no need to include those transactions in the local file. Can you go to the next slide, please? And another thing, another condition for excluding natural or specific juridical person is if activities of one person are not subject to detailed instruction or comprehensive control by that other person, then again you don't need to include those transactions in the local file. Yeah. Okay, I guess that's about it. Swati, over to you.
Thank you, Altaf, for such a good brief. And I think Umang can take over the next topic about the arm's length. And after that, we take all the questions together.
Perfect. Thank you, Swati. Thanks, Altaf,
Thank you.
for the brief introduction on the provisions. And hello, everyone. The next few slides or kind of discussion points that we've highlighted here is largely revolving around some of the practical aspects that would be relevant again from a transfer pricing standpoint in terms of the provisions and how it would impact the businesses. So the question on the slide is whether the related party transaction as reported under IFRS, which is the current accounting kind of principles which are to be followed by any company who operates in UAE or under the corporate tax law. Are these related parties the same, right? So you have a related party disclosure under IAS 24. Would those be the only related party transactions that would get covered under the CT law or the transfer pricing regulation under CT law? Of course, from a question answer point of view, I'm sure many of you would have a view here, but just to answer the question, the coverage of the related party transaction under CT law is much more wider. Okay, and these are few of the distinctions that are identified vis-a-vis IFRS and the corporate tax law. So, say for example, in cases of relationship between two individuals, you have as per IFRS, it says close family members, whereas the corporate law extends up to fourth degree of kinship. So that diagrammatic representation, which we saw on the previous slide, it kind of elaborates or extends the coverage beyond just close family members up to fourth degree of kinship, right? So the uncle, aunt, niece, nephew, all of these also start getting covered besides just the family members. Similarly, in a situation of individual and juridical person also, there is an extension or an expansion of the coverage with respect to the definition. And this is not it, it also further continues between two juridical persons. So, from a juridical person to juridical person, related party establishment also, there is a larger coverage, including, say, permanent establishment, including two or more person which are partners in unincorporated partnership, again people who are trustees, founders, all of these don't find a place in the IFRS kind of IAS 24 reporting. So while there would be IAS 24 reporting that is being done, but I believe with UAE corporate tax law coming into picture and transfer pricing regulations becoming now applicable, it becomes interesting to maybe have another annexure or schedule which expands this. So we're not looking at changing the financials or the reporting per se, but an additional exhibit which would expand the coverage with respect to transactions or arrangement with related party or connected person, as was discussed earlier, would also be need to be captured from an arm's length point of view. Further, we've also looked at the connected person. Now, interestingly, officer, what Altaf kind of elaborated, is an interesting addition beyond just the IFRS definition of IS 24, and therefore it becomes important to also look at who could fall under that category. And again, friends, mind you, this is not just the respective person, which is director, shareholder, or officer. Even the relative or related party of all of these three people would also be captured as a part of the connected person, and therefore any payments made to them would also get triggered to be satisfying the arm's length principle or the market value principle. And I'm sure in our routine case scenario or in real life businesses, there would be many such examples where you have maybe a relative of a shareholder or a relative of a owner or director, or in fact even the officer. So say if you have a wife of a CFO who is drawing a salary from and maybe in her personal capacity, sorry, in her professional capacity, nonetheless the remuneration would need to be satisfied with the arm's length principle or the market value principle. Also, one more interesting element, while arm's length principle or arm's length price happens to be exaggerated in terms of the CT law, or it came to light from a CT law point of view, it's not a new concept, right? So it always existed with respect to the IAS 24 also, where the disclosures in respect of related parties, which were made as a part of IFRS 24, were supposed to be done at arm's length. However, of course, because there was no regulatory requirement or more like a filing that was mandated for these financials in UAE, typically the auditors used to mention saying that these are at prices determined by the management and without any reference to ALB. But ALB always was the requirement when it comes to the related party transactions. Moving further, so I think one of the critical elements that Altaf touched upon, and which is more like a bedrock or a platform on which transfer pricing depends, is the documentation. And largely, what we've seen is while there are thresholds with respect to local file, in one of the recent webinars that was conducted by FTA and also in the awareness session, they have interestingly come up with a concept of general documentation. Now, here, if you see, documentation, of course, financial statements are there, but then you have transfer pricing documentation, into bracket general documentation, right? Now, this general documentation is what is critical, and there are no thresholds currently prescribed to this general documentation. So while local file and master file becomes applicable if you are crossing a specific threshold or a revenue turnover, or you be part of M&E group, which is having a turnover of more than 3.15 billion, general documentation largely applies to each and every case, which would be broken up into two parts. One is the disclosure form, and the second would largely be any other information to support the arm's length nature of the transaction. Right now, how do you support the arm's length nature of transaction unless you really do the FAR analysis, which is functional analysis and economic analysis, and do a benchmarking or more like a comparative with respect to the arm's length or market value pricing, you may not be able to substantiate. And mind you, while you may say that the transaction are at arm's length, or we kind of compete with each other as we do with other businesses, even in related party scenario, unless all of this is documented, and with taxation and with regulation becoming more and more stringent, unless all of this is documented, it would be very difficult to really prove at a later point in time, right? Because I'm sure even if there is a query or an inquiry or kind of questions raised by the FTA, they would be raised after a couple of years or maybe after 3 years of filing. And by that time, you may or may not have all the documents in place unless it is done on a contemporaneous basis. So our suggestion or recommendation is to definitely look at all these transactions, and mind you, not only transactions but also arrangements, right? So the definition under Article 34 covers the term arrangements. Now, what is arrangement? Arrangement is essentially something which is not or may not form part of the financials. Again, in the ensuing slides, we've tried to cover those scenarios, but largely in this part of the world, you come across kind of arrangements which are more oral, right? So you would have a related party loan, or maybe an extension of a credit, or using of common bank account between the group companies, and as and when required, checks are drawn from the common bank account. Now, all of this becomes more like an extension of working capital loan. There may or may not be, they may or may not be reflected in the financials, but then all of them needs to get captured as a part of analysis from an arm's length standpoint. So finally, who does, or to which scenarios or which companies does the transfer pricing apply, right? So after having understood all of this, this is more of a Q&A question, but again, this is also to an extent answered under the FAQs. Few of the glimpse of FAQs we saw in the previous slide. These are another few. Now here, if you look at clearly the question 259, it says, will all businesses need to comply with the transfer pricing regulations, or there will be a threshold for small businesses? The answer is clear or unambiguous. All businesses will need to comply with transfer pricing regulations. Mind you, there is a distinction between regulation and the documentation. Regulation apply to all the businesses. Documentation, there is a threshold which is available, right? Again, the second question, which is question number 260, which also says, regardless of the taxable person's revenue figure for a tax period, the arm's length principle would nonetheless apply, right? So this is a very specific question under the FAQs in terms of the updated version, which was released somewhere beginning of September. Are taxable person required to apply arm's length principle where the revenue of the tax period is below 200 million? So in all situations, ALP is more like a mandatory thing, and you won't be able to prove ALP unless you really or necessarily do all the steps that are required to arrive at an ALP. Right. So regulation applies to all business. Documentation essentially applies selectively. So next, about 5 minutes before we leave the floor open for Q&A, would be focused on the way forward. Now, this is again an interesting provision, Article 61, transitional rules. I'll draw your attention to the Article 61, Clause 2, which says the opening balance sheet referred to in Clause 1 of this article shall be prepared, taking into consideration the arm's length principle in accordance with Article 34 of this decree law. What does this really mean? Right now, this of course means, or the box in the orange below is nothing but an extracted terminology or sentence that we've taken from the explanatory guide, which says that this requirement is intended to prevent non-arm's length transaction and arrangements entered prior to the introduction of corporate tax. So, in fact, while for most of the businesses, the corporate tax will become effective from 1st of January 2024, assuming their financial year ends on 31st of December 2023, transfer pricing essentially applies to them even in the year 2023, because their closing balance sheet, which is drawn up on 31st of December 2023, would need to comply with the provisions of Article 61.2. And Article 61.2 clearly says that the closing balance sheet, which would be just a transition into an opening balance sheet, all the balances needs to be at arm's length. Now, interestingly, what would happen is, if we look at the way businesses are done here, the closing balance sheet of 23 would just not have balances of the year 22-23, right? It would have that of 22, 21, 20. There would be carried forward dues or kind of receivables, shareholders' current account. Now, does it mean that all these transactions would need to be at arm's length? So that opens up a question. Of course, this is more of food for thought, but if one were to look at it from a pragmatic standpoint, at least the closing balance sheet, so all the transactions of 23 needs to be at arm's length and with sufficient general documentation. One would have to prove that these are at arm's length, right? So that's where it becomes more interesting for the businesses and, of course, the tax practitioners as well. Few of the examples that we have considered here, and that's why we say that time to act is now and not wait until January 24 after the corporate tax law kicks in. There would be sales to related party, and the debtor balance would have such sort of receivable. Now, whether that sales was at arm's length, whether the stock being reflected is at arm's length, because every transaction would have two impacts in the balance sheet on the asset side as well as the liability side. So both of these would have to be considered. Now, what happens in cases where closing inventory is not at arm's length? And I'm sure while I'm talking about this, all the participants would have questions. Okay, how do I then reverse it? What would happen to the excise? What would happen to the customs? What would happen to the VAT? Now, these are all food for thoughts right now, but just wanted to lay it open with the audience or with the participants to try and see what all areas would it impact at, right? Because if we say that the transaction is entered and the balance sheet is closed, do I really go back and revise my returns or kind of offer to tax anything which is extra? All those questions are more practical. But definitely, if I look at the provisions right now, those questions become relevant from a restating of the balance sheet point of view. Some of the examples of arrangements that we thought could be important or relevant from a capturing or coverage point of view. And the examples are where we say that there is maintenance of compensating bank accounts, bank balances, or there are financial transactions, guarantees, SBLCs, credit card expenses, directors' villa maintenance expenses, so on and so forth, which are currently being paid and forming part of the P&L. And it may not be really reflected as related party or connected person payment under the IAS 24 disclosures as well. Similar other examples could be the ERP license cost, which is a common cost, or maybe other expenses which are incurred by one company on behalf of another, right? So all these questions start becoming relevant when you are looking at the arm's length principle or the transfer pricing related compliances for your businesses or for the companies and the groups at large. Definitely, people have some sort of misconception. Someone says that, okay, we have an intercompany transfer pricing policy, which is referred as ICTP. Do we need to prepare a separate transfer pricing documentation? ICTP is more of a policy level document. Therefore, yes, you will have to prepare what you call it as a local file or a general documentation that will satisfy the UAE requirements. Someone else would say, okay, I'm going to be a free zone person with qualifying income, and therefore all my income would be 0%. How am I even going to look at 9%, or why would transfer pricing apply to me? Essentially, there is a provision under the Article 18, which is Article 18.1, Clause D, which says that forget coming to qualifying income. For a free zone company to become a qualifying free zone company itself, they need to comply with the provisions of Article 34 and 55, which is transfer pricing, and unless that is done, they won't be able to be eligible to claim the benefits of a free zone company, right? Another few FAQs, two of them which we thought are relevant with respect to group tax grouping. What would happen, whether transfer pricing rules would apply? Generally, the transactions get eliminated, and therefore it should not apply in terms of transaction when there is a tax group under the CT law. Mind you, tax group under CT law is different as far as the tax group under VAT law is concerned. So naturally, you would not become a tax group under CT law because you need to have different set of criteria being fulfilled besides what was applicable in VAT. However, in case a member of a tax group has pre-grouping tax losses, they definitely need to adopt the ALP. So the idea of having ALP is more like a specific anti-avoidance rule. So you have the provision of GAR, which is General Anti-Avoidance Rule under Article 50 of the Corporate Tax Law. These regulations are more of SAR, which is specific or special anti-avoidance rules, which are determined or targeting only to related party or connected person payments, and therefore this become applicable whenever there are tax grouping losses. Are there any exemptions with respect to the documentation? Exempt person effectively are not required so long as they maintain their exemption status, and people benefiting the SBR relief will not be required to maintain the documentation. But again, mind you, this does not mean that the regulations don't apply. Documentation is different and regulations are different, right? So the provisions or regulations definitely apply. It's only about the documentation, and wherever they're referring documentation also, this is more to do with the local file specifically, nothing on the general documentation. So there is a bit of a caution there that I would want to leave the participants with when they are engaging in terms of the review or analysis of their own businesses or their client businesses. So finally, way forward, of course, TP is more of a reality now. Documentation is the key because unless you're able to substantiate, you may not be able to do it later on when there are questions. Any corrective actions that needs to be taken would have to be done right now. Most essential part is having intercompany agreement or pricing policy. Use of other method. So besides the 5 methods, there is a provision of other method, but that also needs to be used selectively. Take timely advice and corrective actions, and the focus should be doing things contemporaneous, which is as on date or as things happen, rather than waiting for maybe an inquiry from a FTA, because then the timeline would be just about 30 days, which would be too short to kind of compile all of that is required as a part of the submission or as a part of the response to the queries, right? So essentially, people need to really look at moving forward quickly. And while we leave the floor open for the questions and answers, there is one more slide with respect to the participants where they will be able to kind of participate in a detailed training if that is required, and they could attend the details of it are mentioned here on the next slide. Yeah, so open for Q&A, and Swati, you can look at the Q&A box, and if there are any questions which we need to address.
Sure. Thank you. Thank you, Altaf, and thank you, Umang, for the informative session. And I'm sure the attendees have a clear idea about the requirements of the transfer pricing and the concept in the whole. So about the classes, I just would like to tell you about our upcoming batch, which, as you can see on the screen, we have 2 full-day classes, which is on the 14th and the 21st. And the rest of the details we can send you over the email with regards to the outline and everything. And it will cover all the transfer pricing aspects. So it will be face-to-face and it will be held in Business Bay. About the questions, I'll take up the first one, Umang. Probably this one is for you. And the person is saying that we have a free zone establishment in Jabal Ali, and for that is for a trading company, and the distribution they have a UAE LLC company on mainland. And what is the corporate tax and transfer pricing impact when the FZD sells to their own company on LLC, which is the LLC, and the owner is the same? But there's only a distributor agreement. This is what I understand. So over to you.
Yeah, so from a corporate tax standpoint, of course, assuming if it is a Jebel Ali free zone company, it would be a designated zone. And if you are able to satisfy all the other criterias, including the de minimis, etc., the corporate tax, possibly you would be a qualifying activity, and you may be able to claim the 0% benefit, or more like a 0% option under the corporate tax law. With respect to transfer pricing, of course, there is no such special status. Any or all of these transactions, and if these pertain to the distribution, they would have to be ensured that they adhere to the arm's length principle. Again, when I look at arm's length principle, and to answer the question specifically, there could be various scenarios, right, where you're not only selling these goods to your mainland LLC companies, you're also selling these goods to even other unrelated third parties within UAE or outside of UAE. So one option is where you compare these prices of the transaction between the related party, which is your LLC company in mainland, and the other unrelated party. So one is more of a price-based comparison, and another is a more of a margin-based comparison, where you try and see if the margins that are earned by your free zone company or your LLC company, depending on whom you select as a tested party. Now, tested party again is a concept under transfer pricing, but one of these two parties whose margins are being kind of tested with respect to satisfying the arm's length principle or criteria, you could look at more like a external or a third party database search, try and arrive at similar kind of businesses who operate under same industry, or part of the similar value chain. So you are a distributor, so maybe a distributor who operates under similar product line or industry as yours, and what is the margin that those kind of comparables are earning, could be another benchmark. So there are two or three options which exist, but yeah, CT law, possibility of claiming the 0% does exist, with, of course, looking at the facts and the kind of criterias. And the TP, it definitely applies, but you could have a couple of options to try and establish that the transactions are at arm's length.
Thanks, Umang. The next one is will common office rental expense sharing ALP applies?
Yeah, so common office expense, again, if I look at it, you need to determine whether the office expense in terms of only the rental or even the running expenses are being considered, right? Now, again, it goes back to the simple question saying that are these costs being divided? Ideally, these costs have to be divided. Now, then we come back to the point in terms of the quantification, how you divide it. Now, each of the cost would have a cost driver. Say, for example, if I'm looking at a rent, now rent could be divided based on, say, the area that is being occupied by, say, assuming there are two companies, company A LLC and company B LLC. Now, both these companies, assuming occupy 50% of the office, then the rental would be divided at 50%. Now, if we don't have more like a rental division, then we look at the number of employees, because that could be another key driver. So on and so forth for each of these expenses. Essentially, you will have to look at more of a division or split up of the cost. The next question, which ideally or logically come, is whether these would be charged only on a cost to cost basis. Now, there again, it remains to be determined whether these are being provided as a general facility, or these are being provided as an add-on services. Now, if these are provided as an add-on services, then there would be an element of markup or margin being added to be charged to other group companies. So if there is company A LLC who is incurring the cost, and there is company B LLC and company C LLC who is getting the benefit of this cost or these services, then A LLC, besides just the split of the cost, should also be looking at charging some sort of a margin or markup. But again, all these are more fact-driven or subjective questions which can be answered with more facts.
And it should be, I think, with the support of a contract in place, mentioning the terms.
Yeah, absolutely.
So let me take the next question.
Yeah, I think the last one possibly we have that we overshot. So yeah, the last one
Sure.
that we can go and then.
Sure. How would you consider the FMV ALP while doing the intercompany good transfer entries?
I didn't really capture the question in terms of the essence, but if you are able to have a fair market value to the goods that are being transferred, and more importantly, any document that substantiate that this is the fair market value. So in situations where you say transfer machine, you would have maybe like a chartered engineer certificate which is given. Now those certificates, because these are by the industry expert or the subject matter expert, would be considered as one of the factors that would help you defend that whatever was done with a good faith and in line with possibly how it would be expected. But if I were to,
Umang,
yeah.
Umang, let me. So this question is actually I understand this. Why? Because it's a lot of textile, lot of golden jewelry, lot of other trading entities have this question. It's a very big question actually circulating in UAE. Basically,
Mhm.
what they're asking is from an inventory perspective that when one company which is into trading business buys inventory and gives it or sells it to a related party, how does the arm's length principle of fair market value apply? That's their question basically.
Yeah, so then in that case, again, we go back to the options that are available, right? So if I'm buying from a third party and selling it to a related party, whether I'm just selling it to a related party or I have other sellers or customers as well. So then I have a possibility of a price comparison where one sale is to a related party and same or similar goods under same or similar commercial terms, including the credit period, including the currency, etc., is same or similar with unrelated party. Now, if there exist these kind of comparables, then price-based comparison becomes a much more appropriate mechanism. But more often than not, any variation in the commercial term would influence the price. So our experience shows that a margin-based comparison would work well because that kind of, to an extent, also irons out any differentiation with respect to these terms to the extent possible, and therefore becomes much more pragmatic in terms of looking at the comparison per se.
Thank you. That was insightful. I think we are overrunning the time now. So the rest of the question, we will reply to them through emails privately. And I thank you, both of you, for the comprehensive presentation. And I'm sure all the attendees enjoyed listening to both of you. For the course, we have some question, which whether it is online as well. It is online as well, and we'll share the flyers with all of you through email. Thank you once again, everybody, to be part of the webinar today. It was a pleasure. Thank you.
Thank you very much. Thanks for having us.
Thank you. Good day. Bye-bye.